Let's get a top-down look at what's moving the market and how that will impact the local market here. Peter Mcguire from XM joins me now. Good morning to you, Peter. Nice to see you. Talk to us about what we are expecting here locally today.
Well, good morning, Nadine. I think, if you look at the fabric as far as Australia, you might see a little bit of a pullback, but I mean, the market's been very, very toppy over the last month or two, and that, hot air can just evaporate a little bit. You can take a couple of percent out of it over the week, but I think the overall trend is certainly upward, and that seems to be very, very solid over the last, represented by nearly every bourse in the world. So I'm not too worried about it. Markets are cyclical, and, a little bit of hot air comes out, and then that's probably not a bad time to buy.
Okay. We have data due today, but it is a very heavy week as far as central bank action and the rest of it. Just walk us through, Peter, what you're expecting.
Well, last week was a big week, and it builds on that, Nadine. So you got the Fed naturally, you got Bank of Japan, Bank of England, and a couple of the others, as you mentioned, Norway and so on. So if you're looking at the first off, I think the Bank of Japan, 10% chance of 15 basis points worth of rate cuts. That's what the market is probably suggesting. It's about a 60% chance of 25 basis points. So there's the first part as far as Bank of Japan. What's the Fed going to do? Pretty much tabled in that we're going to see 25 basis point cut, probably 50 basis points by the end of next year. That's what the Fed Fund Futures is pointing to. So there's the storyline. So that's where I think everyone's got a mindset, that US dollars had a really nice uptick, nearly at 107. And a Bank of England, 10% chance of a 25 basis point cut. And some are even pricing in, one maybe by March. So it's either going to happen or it's not going to happen. They're going to sit on their hands.
Okay. So that was the inflation data that we did see last week. When you are considering the commentary and the economic forecast coming from the Fed, I mean, what are you expecting to hear about the US economy?
Well, I mean, when you think about it, Nadine, have a look at what's happening as far as GDP. It's been fairly solid. If you're looking at non-farm payrolls, it really bounced back. November was far stronger than what you saw in October. So that's a good sign. We're entering the Christmas season as far as sales and all of that. So I think the upward trend and the high post-election has been very solid. And that's been pushed across as far as the Russell 2000. A lot of these markets have had extraordinary gains in the last couple of months and building on where President Trump was elected, and that positive tone has been continuing. So keep an eye on the Russell, keep an eye as far as what if commentary coming from the Fed, and where we roll forward up to, the end of the year. I'm expecting things to remain at the status quo unless you see something dramatic happen geopolitically or a surprise.
Well, we've got oil up 2%, so at a 3-week high. So instability in the Middle East, also unknowns around Iran and Russia, sanctions possible there. And then we've got sort of the economic story happening in Europe and the US, particularly if we continue to see these rate cuts come through. What's your outlook for oil, Peter?
I think a continue uplift. I wouldn't be surprised. It seems to be range bound. It goes up to, that mid 70s, 76, 77 as far as Brent, unless you see something dramatic build geopolitically and maybe Iran gets pulled into this. But if it doesn't, then I think it'll probably hit 76, 77, and then possibly give off a lot of those gains. Be conscious also as far as US dollar index. That's had a very strong run up over the last 6 or 8 weeks. It's been, best part of 6%. So you can't discount that, Nadine. WTI sitting at 71.30, maybe a $73, $74 handle. But, geopolitics, and I keep on mentioning that because we have got some very, very hot zones throughout the world. And if one of those was going to escalate and be in an oil traffic area, be it Iran, then that could really change the fabric as far as price.
I guess a lot has to do with the US dollar as well. Lots of pressure coming through on the Aussie dollar. So in your view, does the US dollar remain strong to the end of the year?
I think so. I wouldn't be surprised. I mean, let's have a look where, from a Fed policy decision, what happens this week, and maybe it gives off, but I think that's pretty well baked in. It might give off, half. So 106.50 might be the low, but that Aussie's been crushed. Also the yen, 153.65. The euro's through 105 now. So everything seems to be one-way traffic as far as US dollar, and I wouldn't be surprised for that to continue leading up to the end of the year. President Trump's come out and quite openly said the US dollar is the currency of the world, and that's king dollar. So it seems to, very much be moved appropriately towards those comments.
All right. So is it a good time to be a trader, Peter?
Great time to be a trader, Nadine. What a great question.
Good.
24/7. If you want to trade, the opportunities are immense because of the volatility. And I think every trader needs to be conscious that if you miss out on a trade today, that doesn't mean hang up your socks. The opportunities present themselves all the time. Find something that you enjoy. Read a book as far as like Hot Commodities for Jim Rogers. Understand the landscape across a sector. Either it's currencies or commodities or stocks or naturally interest rates. But I think that, you've got do your homework, look at the technical analysis, and what a lot of these trading companies offer is incredible research, and they teach people, hold their hands to understand how to read technical analysis, understand the fundamentals, and appreciate seasonality, which, we're coming up to seasonality, Christmas, and of course, New Year, Nadine. So these are all big moving parts that create, I think, opportunity, and you just make twice as much money normally in a falling market than a rising market.